In this video, we're going to talk about what are futures in trading. So it's very much going to be a beginner friendly video and description of what futures are when it comes to trading and what forward contracts are and how you can trade them. So my name is Tyler Stokes and I'm on a journey to become a full-time day trader. And in the beginning stages of this journey, we're doing some review of stock market basics and we are on futures. Now, if you want to download the 6-month blueprint that I'm actually following along to become a day trader, you can find a link to that below in the YouTube description. And you might be here for various other reasons. You might be interested in futures for just investing in general. Maybe you want to be a day trader as well, and you're thinking about day trading futures and you sort of don't know what they are. That's what we're going to cover in this video. Now, when I jumped in and started researching futures, it actually took me a while to come up with what we're presenting in this video. I just kind of couldn't grasp exactly what they are. It took me a while. So hopefully by the end of this video, you will understand what futures are, what futures contracts are, and how they are traded. But if you need to source some other material as well, I certainly did when I was starting. So let's jump right into it and talk about what futures are and how you trade them. So for this article that we're going to reference in this video, I'm going to use the example of oil in some of the sort of examples when we jump into actual contracts. But obviously you can interchange oil with any other commodities like gold, soybeans, coffee, and so on. So oil just kind of seemed like an easy one to use for the examples. So imagine you promise to sell or buy oil at a certain price on a future date, like in 3 months. That's what a futures contract is. So it's a promise between two people to trade something at a specific time in the future. And these contracts are usually for things that vary in prices, like commodities, so like oil. So a futures agreement, again, it's just a futures are an agreement between two people. So you and I, we agree to buy and sell something at a specific date. That is what a futures contract is. So a market exists for these futures because people are willing to buy and sell them, and they come together in a market where I'm going to buy something from you at a future date. And then there's a market for this because there are buyers and sellers. And again, they're typically buying and selling commodities. So you might be thinking, why do these futures actually exist? Like, when did they start? How did they come about, and why? Well, the first reason is for hedging. So, if you're an oil producer and you're worried about falling prices, you can hedge by using a futures contract. So by locking in a selling price for oil in advance, you ensure a stable income regardless of future market price fluctuation. So if you think about all the commodities out there and the various businesses that are associated with them, you can see why there are many of these contracts around. An oil, for this example, might want to lock in a price if they think the price of oil is going down, so they set up these futures contracts. People that are doing other raw materials, other commodities, coffee, metals, other energy products, they would want to do the same thing so they can hedge in case they think that the price of their commodity is going to go down or going to go up in the future. So going up meaning if you buy this raw material like coffee beans and you think the price is going to go up and you're a coffee bean distributor, then you would want to maybe hedge against your thinking that the price is going to go up and lock in a price now at a future date of delivery. So that is sort of why futures exist. That's one of the reasons. Now, you and I are never going to really do that. I'm assuming you're not going to actually buy commodities. You don't have a business where you get the raw materials in, like coffee beans or various metals or other agricultural products. So we're going to do speculation. So speculation is the other reason these future contracts exist, or the other way to use them. And this is like making a guess. So some people, they buy and sell futures contracts betting that the price will go up or down. And they do this to try and make money from these price changes. And that's what we're going to do as traders. And I'm assuming you're watching this because this is sort of what you will typically want to do. Now, there is this difference between futures and forward contracts that you might come across when you do this type of research. So let's just go over and dive a little bit deeper into what these are. So a forward contract, these are like special promises made directly between two people or two companies. They're not traded on a big public market, and they're custom made for the two parties instead. And this is called over the counter. So it's like a special order that you might make at a store just for you. And a brokerage firm or a bank or some sort of organization is going to help facilitate this deal, but it's between two people and it's customizable. Whereas futures contracts, these are like standard promises that are traded on a big public market, like an exchange, where lots of people can buy and sell them. So these contracts, they have rules about the sizes, the quality, and when the actual trade can happen. Every day, the market looks at how these contracts are trading and what they're worth, and people might make or lose money depending on them, depending on the price changes throughout the day. So that's called mark to market. So you get a new market price or the market value of the contract at the end of each day. Whereas with a forward contract, it's set in stone, so to speak. The price fluctuations of whatever you're trading is not going to affect that contract, or there's not a new price for that contract. So we're going to do a few real life examples, so to speak. I'm going to read them here, and then they're going to sound very much the same, but when we dive into some of the specifics, we'll get a better and clear understanding of the difference between these forward and futures contracts. So forward contract example, let's think of maybe a farmer. We'll call him Farmer Joe, and a bakery owner. We'll call her Betty. Joe agrees to sell wheat to Betty at a set price in a few months. This helps Joe know he'll get a fair price and helps Betty plan her costs. So this is a wheat distributor and a bakery owner. They're hedging and using a forward contract to hedge the price of this commodity. A futures contract example, an oil company and an airline make a deal where the company will sell oil to the airline at a set price in the future. This helps both sides plan their finances without worrying about oil price changes. Now, if you kind of read those two and we kind of listen to that, they do sound very, very much the same. But if we dive in a little bit deeper, there are differences. So the forward and the futures contracts there, they might sound similar, but here are some differences. Forward contracts. So first of all, they are customizable. So the agreement between Farmer Joe and Betty can be customized specifically for them, and it is customized for them. It means that they decide the terms, like how much wheat, what the price is, and what the actual date is. It's also private and direct. So the contract is made directly between Joe and Betty. There's no involvement from anyone else. So this is like making a small deal in like a small private group. Flexibility, since it's a private agreement, Joe and Betty can, they can adjust the terms that suits their needs. So we kind of talked about that, changing the delivery date or the amount of wheat and so on. Now there is a little bit more risk because if one of them can't honor this deal, there's no sort of big system in place that can help fix their problem. So that's a forward contract, and you will not be dealing with forward contracts. I'm assuming neither will I. These are between people that are actually buying and using the commodities. We, as day traders or as investors, you're probably going to just use futures contracts where you don't really want to take the exchange of the actual commodity. So futures contracts, they're standardized. So the deal between the oil company and the airline, it's a futures contract, meaning that it's standardized. The terms of the contract are standard. How much oil, what kind of oil, the price, and the date. They are set by a market, not by the two parties. These are traded on exchanges. So this contract is traded on a big public market like a stock exchange where lots of people can buy and sell similar contracts. So it's not something that can just be sold between the oil company and the airline. Mark to market. So every day the value of this contract is calculated based on the current market prices. And then there's lower risk. So there's less risk of someone not honoring the deal because the exchange contract it keeps an eye on where the contract is actually exchanged on, like the market exchange. The commodity, the futures exchange market keeps an eye on things. There's rules to manage risks and all that sort of stuff. So the key takeaway, the main differences are how the contracts are customized for forward contracts, where it's traded, and how the risk is managed. Forward contracts, they're more like personal deals between two parties, while futures contracts are like buying a standardized product from like a big store where rules and there's a system that is in check. So in this example, the oil company and the airline, they are likely to use this forward contract for actual delivery. So this is where it kind of gets a little bit confusing as well, or at least it was for me. So they're going to actually use the contract for the delivery of that product. Just like Farmer Joe and Betty, they're going to use that forward contract to actually deliver the wheat, and she's going to accept the wheat. The airline and the oil company, they're going to use the futures contract to also do the same thing. However, traders in the futures market, our speculators, they have no intention of taking or making delivery of the physical commodity. So you can use a futures contract that's standardized to actually trade the commodity. Two businesses can do that, but traders can actually use the futures contract as well, but only to speculate on the price changes and never actually take delivery. So we'll dive into this even further here. So how, you might be wondering, like, how does that work? How does speculation in futures trading work? Well, we'll call traders speculators. We're kind of using that interchangeably here. Traders and speculators trade futures contracts just to make money. So that's what you're going to be doing as a day trader. That's what I'm potentially going to be doing as a day trader. We don't really want the oil or the wheat. We just want to buy and sell the contracts, hoping to buy low and sell high, or the opposite if you're selling or buying to take a profit. So it's like betting on which way the price will go. So buying and selling the contracts, this is how it sort of works. Speculators trade futures contracts on exchanges, so just like stocks. So there's stocks, various stock market exchanges like the NASDAQ where Tesla's traded, the New York Stock Exchange, other big companies are traded. There's an exchange where futures contracts are traded, and they buy it. Us traders, we buy it believing that the price of the underlying commodity, so oil for this example, will go up, and we're going to sell one if we think the price will go down. So there's no physical exchange. So unlike the oil company and the airline example, speculators are not interested in the actual oil. They're only interested in the contract itself and the price changes of that contract. The profit comes when there are price movements in the commodity. So the goal of a speculator is to profit from short-term price movements. For instance, if a speculator buys an oil futures contract, so that means you're going long, you're buying the contract, and the price goes up, they can sell the contract for more than they paid, making a profit. And the other way is the same thing. If you as a trader expect the price of oil to go down, you might sell a contract, so it means going short, in hopes to buy it back later at a lower price. So closing positions before expiry. Speculators always or usually, close their positions before the contract expiry date. So this means they sell the contract they have bought or buy back the contract they have sold before the contract's delivery date. So by doing so, they settle the position in cash without ever dealing with the physical commodity. So when you trade these futures contracts, you buy and sell them, you're never going to let them go to expiry where any commodity is meant to be delivered. You would just settle in cash. So if you're selling one and it hasn't been sold, you would buy it and at the new price, whether it's gone up or down, you take a profit or a loss. And if you were, and then conversely, the other way around, you would settle your contracts basically and not let them expire. So there's no delivery of any underlying commodity that needs to be done. And then mark to market there, daily marked to market prices in futures trading means that the gains or losses from these contracts are settled at the end of each day. So here is another example, just to kind of cement this idea. So imagine you're a trader and you think the price of oil is going to go up. So you buy an oil futures contract at the current price. If the price of oil increases the next day, the value of this contract also increases, and then the trader can sell the contract for a profit that same day, or you can hold on to contracts for more than one day. But if the price of oil decreases, the value of this contract also decreases, and you might choose to sell it at a loss to avoid further losses. So if the price goes down and you're at a loss, you might want to sell and get out and just take that loss rather than incurring even bigger losses. So when a trader buys an oil futures contract to speculate on the price, they're not buying a contract that already exists between two specific parties. Instead, they are entering into a new contract on a futures exchange. So the oil company and the airline company they would have their own contract set up. You as a trader will go into your own contract on the futures market. So if we dive even deeper, I know sometimes this is not super clear. Let's keep going with even more examples here. So again, you can substitute oil with any commodities, but what happens, when you buy a futures contract? So you are entering a new contract. So when you buy an oil futures contract or any type of commodity futures contract, you're essentially entering into a new agreement. So you agree to buy a set amount of oil at a specific price on a future date. This contract is then matched with another market participant who takes the opposite position, so agreeing to sell oil at the same terms. So no physical exchange initially happens. So you're not buying actual barrels of oil, you're buying the rights and obligations under the contract. So that's really the nail in the coffin to what these really are. So initially, there's no physical exchange of oil. Instead, you're gaining exposure to the price movements of oil with these contracts, and then they're traded on an exchange. So this transaction occurs on a futures exchange, a marketplace where traders can buy and sell these contracts. Now, there is a margin associated with this, so a margin account. So to buy a futures contract, you're not going to actually pay the full value of the oil up front. So that would be, thousands and thousands of dollars to the actual contract of that oil getting delivered at a specific date. Instead, you just pay a margin. It's a fraction of the contract's total value. And this sort of acts as like a security deposit. So your profit or loss is going to depend on the price movement of oil. So if the price of oil rises above the price at which you agreed to buy it in the contract, you can sell the contract now for a profit. If the price falls, you may incur a loss. And then closing the position is the other way it works. The last point here, most speculators, they close their position before the contract's expiration date. This means that they sell the futures contract they have bought or buy back the contract they have sold to realize their profits or losses without taking any delivery of the oil. So you're not going to let the contract actually expire. You're going to close it with cash. So key takeaways: when buying an oil futures contract, or again, any futures contract, you're not purchasing the physical commodity, but rather the rights and obligations of the contract. The contract is a commitment to buy or sell a specific quantity of oil at a predetermined price on a future date. Your goal as a trader is to profit from price changes in the commodity like oil, and you typically close the position before the contract expires to settle your gains or losses in cash rather than dealing with any of the physical oil. So in summary, while futures contracts can be used for actual commodity transactions, they're also a tool for speculators to profit from price movements in the market. And that's exactly what you would be doing as a trader, what I would be doing as a day trader as well. So we talked a lot about, the price changes. So let's just really go over, just to end this video, on what you're actually speculating on. So what are the things that could cause the price of oil, for example, to change? So the first one here is, supply and demand. It's the most fundamental factor. If a commodity is high in demand, low in supply, the price is likely to increase. Economic indicators can affect commodity prices. So GDP growth, employment figures, inflation rates, they're all going to impact commodity prices. Geopolitical events, so political events, wars, conflicts, we saw that with the Russian and the Ukraine war there. Commodity prices for agricultural products certainly were affected. Weather, natural disasters, so weather for droughts, floods can affect crops and other agricultural products. That's going to change the price of commodities. So tracking all this stuff can be quite exciting. Currency fluctuations, market sentiment, government policies, and regulations. So if there's new regulations on energy products, that could affect commodity prices, and so on. So there's a lot of things that can go into affecting the price of various commodities. So day traders in the future markets, you try and predict the changes, make quick decisions on buying and selling these contracts, hoping to profit from short-term movements. And I think that is where we will kind of tie up and end this video. We went over a lot of things here, a lot of examples. I'm going to leave a link to this article in the YouTube description. You can reference it and sort of maybe read it a few times. I know I kind of went over it quite quickly there, but that's sort of what futures are and sort of how they work. Now, in future episodes, what we're going to do is actually pull up a dashboard of a brokerage account and go through on a paper account, so a simulation account, buying and putting some of these orders in, because although we talked about what they are here, when you actually look at how they are sold and bought on an exchange, on a brokerage account, from your computer, it's a little bit different than buying stock. So the prices are different, the way the quantities are sort of laid out, and how that works in the dashboard is a little bit different. So although in this video we sort of talked about what futures contracts are, the difference between futures and forward contracts, and sort of why they exist and how they're traded on the market, it's always nice to actually jump in and actually see a live kind of view of trading and buying and selling these futures contracts on an actual sort of dashboard of a brokerage account. So we will be doing that in the future when we set up our brokerage account. So subscribe to this channel if you're interested in that. I hope that you found this video useful. You can subscribe and follow this journey that we are on towards becoming a full-time day trader. And again, in the YouTube description, you can find more resources, notes, and then I hope that you found this useful. And if you need to go out and source other material, there are a few other good resources on YouTube that sort of kind of dive in to the whole futures market. So again, thanks for watching, and I will see you in the next video.